Tristan, welcome to Validated.
Good to be back here.
Yeah, excited to have you back on. So we got a ton to talk about today. We should set the stage that we are talking at the beginning of the market apocalypse today. And I think I want to just call that out for audience members that if our tone seems a little off based on the future of where you're watching this is the moment in which we are recording today. But I actually love doing episodes in these sort of moments of potential change, or at least a bit of uncertainty, because it kind of strips away all of the crap of whatever's happening in the day and lets us kind of focus in on the stuff that will be true today and true tomorrow and sort of true in the future. So with that, let's get into it. Tell us a little bit about Zeta, just to kick it off, for those who may have not used it before.
Yeah, absolutely. So to kick it off, I'm Tristan, and I'm one of the founders of Zeta. Zeta started in early 2021, I would say. We got introduced to Anatoly in the very early days of Solana. We're fortunate enough to kind of see the benefits of Solana and what could be built in DeFi. And very much in those early days, it stuck with me when Toly said that we want to bring NASDAQ on chain. That always kind of stuck in my mind. And that was kind of driving me through building this startup, essentially. And so we're trying to bring derivatives and DeFi on chain. And that's our big value prop. So we are basically a perps exchange. Perps are one of the most ubiquitous products out there for trading. It gives you leverage. It gives you really good kind of price discovery and capital efficiency. It's what everyone loves to trade. You can go long and short. It's just kind of a no-brainer for any kind of entry into crypto. And so we've seen these big platforms like, Binance and Bybit and OKX, which are massive for perps trading. But we haven't quite yet seen that proliferate, I guess, on the decentralized side, which is what we all want to see. We want to see self-custody. We want to see transparency. We want to see things being done in code on chain. And so we were one of the first teams to bring the central limit order book on chain, building off the backs of what happened with Serum in the very early days. We took a bunch of those ideas and decided to apply it to perps trading. And so we built that out fully central limit order book, perps exchange with leverage and a full margin system. And that's what we've kind of built over the last couple of years. And now we've got to a place where we've done, I think, over $10 billion worth of trading volume. We've catered to over 100,000 users, and we're continuing to scale and build that into kind of the next version of our exchange, which will actually be built on a Solana L2, which is currently in development. And we can talk more about that.
I definitely want to get into that side of things, but to kind of just start at the beginning here, for folks who maybe missed it, there's an episode with Tarun from a few episodes ago where we go into sort of the history of markets and derivatives and sort of why those things are interesting. So highly recommend going back and checking that out if you need a little bit more background in what these things are. But I want to kind of start out with why we haven't seen more derivatives and perps on chain yet. Because, we go back to the early days of crypto and we get Bitcoin with no smart contracts. And so you need, if not a centralized exchange, at least an off-chain exchange in order to actually facilitate things like price discovery and order matching. DeFi Summer, the original DeFi Summer, brings a lot of these things online with very basic AMM functions like the version 1 of Uniswap, where, suddenly there's a function that governs what price should be based on supply and demand of two assets on chain. So what's taken so long, in the history of the crypto arc to actually get perps and derivatives fully on chain? And why was that a challenging proposition?
That's a really good question. So I've definitely noticed this gradual evolution of, I guess, the technology behind blockchains, and that kind of enables more and more complex use cases on chain. So like you said, we've kind of gone through this early DeFi wave, years ago, where we have Ethereum, which people like to liken to, I guess, the kind of dial-up internet. You have very low bandwidth, things are kind of slow, and you can kind of only do these, I guess, fairly simple primitives like AMMs, which worked great, I guess, in that kind of scenario. But when you compare it to what's happening in traditional finance, AMMs are taking a few seconds or, kind of minutes to rebalance, things like that. And then you look at traditional finance, things are done on nanosecond, microsecond levels, people setting up specialized high frequency trading infrastructure. It's orders of magnitude different. And that's obviously because we're very early in that life cycle. So like I was saying, in the DeFi side of things, we've seen these very, I guess, basic primitive use cases coming out. A lot of spot trading stuff, AMMs, which are very simple. We've seen stuff like lending do really well because it works on slower time frames. It's a bit more kind of reliable. But then I guess we haven't seen like the very complex and sophisticated edge of things happen. So a bit of context, we actually started as an options platform. That's when we first got started on Solana. And that is very complicated. You've got to basically do modeling in terms of the margin system. It's all this kind of like non-linear maths, very complicated stuff. I actually built the first Black-Scholes formula for options margining and wrote it all in Solana in like basically all the kind of Solana smart contract code. I had to do a lot of re-engineering. You can't even do floating point math really on Solana. You have to kind of go and think around the box because the compute constraints just make it too difficult. And Solana was already kind of like a 10 or 100x improvement over Ethereum. And that's kind of why we ended up moving from Ethereum very quickly to Solana. But even then, there were kind of limitations. And so I think those kind of limitations continue in terms of what you can build. Thankfully, Solana in its present state and over the last couple of years, I think has been really good in that it has enabled a bunch of these fully on-chain exchanges, which is what we've managed to build out. You know, people thought it was impossible to have a central limit order book on-chain until Solana came along. And there were some kind of hiccups and things, but generally the runtime has improved so much over the last couple of years that, us and a bunch of the other kind of major protocols out there have literally facilitated billions of dollars of trading volume, all on chain, all done on smart contract technology, which to me still kind of blows my mind. Like that's incredible. And then to answer your question, like how do we go from here and how do we compete with, I guess, the centralized exchanges and take market share away from them? So I think there's still a bit of a void in terms of the technology that we need to kind of bridge the gap on. I think when you're looking at a Binance, what do they have? They have extremely fast place order latency. It's on the order of milliseconds. They don't have any kind of like throughput constraints because it's obviously just centralized, Amazon box or something like that. And so it's very hard in a decentralized exchange setup and like a fully decentralized network to be able to compete with that. So with Solana, even the block times 400 milliseconds, they're great. But you're not getting quite the same level as the centralized exchange, which means that for traders, it's kind of noticeably slower. For market makers, this is actually a big deal. I would say for regular traders, 400 milliseconds or 20 milliseconds, like you don't know the difference pretty much. But for a market maker, that is all the time in the world, essentially. And what they're doing, these market makers they're taking millions of dollars, they're putting on an order book, and they're saying, I think Solana is, $200 plus or minus, essentially like some small spread that they clip. And if they're wrong about that, someone comes in there and they do this toxic order flow. They take this thing and they're like, boom, I just made, $10,000 or something or other off that. And obviously you're just going to bleed money if you're, too slow. And that's something we found with our market makers is if they're too slow to replace or they hit chain congestion, they basically can't quote super tight, which means that when you look at us versus a centralized exchange, it's pretty competitive now, but it's very hard to get, one-to-one with them because some of these kind of like speed considerations. And so we kind of realized Solana is really good and it's got us this far. We want to kind of take the best properties of Solana in terms of speed and scalability and tailor it, I guess, to the kind of DeFi and perps use cases. So if we can build something that is more customized in terms of the infrastructure, but still kind of secured by Solana, we can bring down the latencies, the speed. We can do stuff with the gas to onboard, users better and not have this kind of, having to sign every transaction. And then hopefully that will bring derivatives on chain and we won't have to get shoehorned into centralized exchanges anymore.
Yeah. So I hear you pushing into the L2 narrative and I want to get there. But before we kind of like move on to that sort of next architectural phase, walk me through how people are using Zeta today. There's this whole idea of like the capital triangle, and there's these sort of three, pillars that sort of hold up a lot of traditional TradFi market structures. How is that being built the same or differently when you look at DeFi on Solana, and where does Zeta sort of fit into that stack?
So I guess if I'm trying to understand your question is like comparing it to the traditional stack in terms of how we built our exchange. So the traditional stack is actually very complicated. If you look at a traditional bank or an exchange, you have so many components. You have a clearinghouse, you have the kind of exchange itself, you have the broker, say, you just have all these kind of different people, the custodian. There's so many different counterparties and people that you have to work with. And that kind of introduces this middleman problem, I guess, where everyone is taking their own cut, their own fees. And then there's just a lot of parties that have to work with one another. If you've ever used banking, for example, today I off-ramped a bunch of stuff, having to worry about ACH, ABA bank numbers, SWIFT numbers, and kind of moving it. I mean, they kind of unified a lot of traditional banking under, stuff like SWIFT. But if you look at it, under the hood, all this kind of stuff is very, I think, old technology that is very slow and very kind of error prone potentially. It's not built for, I would say, this internet age. So the beauty of blockchains and specifically Solana is we can take all that complexity of, traditional exchange, and we can just compress it into a smart contract, which is like less than 10 megabytes of code that we've just uploaded to the blockchain, which, that's like pretty mind-blowing innovation to me. And so that's basically how Zeta works, is we've taken everything from the custody is all self custody, smart contract custody, essentially. We use this concept of PDAs in Solana. So people own their own funds. It's not a centralized exchange where it's like, hey, trust me, bro, give me your keys and give me your coins and I can do whatever. And, if you have a malicious actor from a centralized exchange, they can just kind of rug pull you. That doesn't happen with DeFi. You can put your money in the smart contract. It's basically held by you. You can withdraw anytime. We also handle stuff like the margining is all done on chain. We pull prices from Pyth, which is one of the Oracle providers. So they basically aggregate prices from, call it like 10 or 20 different providers. So it's reasonably decentralized. And then we do all the kind of margining. We make sure that, hey, you want to buy the Solana contract, you have enough actual USDC in your wallet to kind of support that. Other functions like liquidations are done permissionlessly, so anyone can run a bot. Sometimes like us or investors or other, parties that we work with run their own. So it's completely open and anyone can kind of run those. And then you're basically just placing a message on chain. You're signing this thing, you're sending it off. It's on the blockchain, on the order book there that's resting in an on-chain account. And someone on the other side of the world can go and they can place an opposing order and say, hey, I want to sell that Solana to you. And they sell that gets matched essentially. Validators around the world run that piece of logic and kind of all agree that it's kind of matched. And then a trade happens and funds are basically exchanged. And yeah, it all kind of happens in this one piece of code that's run on, the 1,000 Solana validators that are there. So it's, I would say, a drastically simpler model. And it's also really nice because the whole thing's transparent. You can just go, you can look at the notification, you can jump onto an Explorer and you can verify that it's happened.
Yeah, one of the things that always surprises me about how complex DeFi protocols, and Zeta definitely falls into that category, have gotten built out is that they've kept a lot of this idea of permissionless actions, which if you go back again to the basic AMM function of something like V1 Uniswap, there's really no role for Uniswap, the corporate entity, besides as a software publisher, right? In that model, you have liquidity providers providing liquidity, you have, sellers, you have buyers, and the whole system is like very self-contained. And there's no sort of there's no cranks that are necessary. There's no additional outside tools necessary to make that work. But you get to something like Zeta today, and you're talking about permissionless liquidations. Now, liquidations, I would say, are probably one of the least important functions that an external capital provider can provide, right? Like liquidations are not really doing, I would call them productive work, the same way that providing liquidity or providing order flow or something like that is. And so there's a world where you guys could have just said, look, we're going to take all the liquidation profit, right? This is something that, or we're going to sell access to be a liquidator on the system. And I think, in a traditional exchange structure, no one would blink at that at all. And even in a decentralized exchange, you probably could have gotten away with it to some extent. So walk me through a little bit of the philosophy of building this stuff fully in the open and in a situation where you are actively giving up profit-making opportunities to keep the protocol open and access. This stuff, to me, a lot of it feels like it's competitive to TradFi because it's just trying to play in such a completely different philosophical way than you see the traditional systems built. Would you agree with that?
Yes. Yeah, it's a pretty good observation. I mean, we definitely started this thing as trying to make it as kind of open as possible, build in the open. And for us, I guess, in terms of liquidation specifically, we see it as yes, it's not it is a critical feature, but it's more like a security mechanism, essentially. The reason you have liquidations, for people who don't know, is because there's leverage that's allowed on the platform. So people can actually take on more risk than they have capital to basically cover. And so if a position ends up going underwater, you don't want it to go over bankrupt. You don't want the person to lose more money than they have in their account, essentially, because that gets reflected essentially on
Right. That's
the exchange's
contagion.
balance sheet. Yeah, it's contagion. It dips into the insurance fund. We got to kind of cover it. So essentially, and thankfully, because Solana is so fast, we haven't really had too many issues because things are able to kind of liquidate quickly. But yeah, we've just kind of opened it up because we figure like there's a lot of people out there. There's a lot of interest. I mean, definitely in the early days, I think when Solana was not as hot as it's been this last year, it was very hard to get people to come in and liquidate. So we would just come in and just like run an internal thing. But the really cool thing that happened was we would run this internal one. We found probably like a year ago when things started heating up and people started getting really interested, we were just getting absolutely fleeced. Like people were just beating us out to every liquidation, and we hadn't put much kind of thought into improving this script. It was just kind of like a legacy thing. And now people are just kind of jumping in there and they're just kind of beating us to the punch on all those kind of things. And there's profit there. So there's kind of like a motivation for people to do that. But yeah, people just simply coded much better scripts, probably used some, kind of funky like Jito technology to do MEV stuff and just get really competitive. And now it's actually quite a competitive market. People get in there and there's kind of like a race to kind of bring these things down. But that's actually a good thing for us because it means more people coming in, stepping in, providing capital and getting those liquidations off faster, which protects the exchange and all the people using it from bankruptcy situations.
Yeah. So what do you see over the long term as like Zeta's, let's call it economic driver function for the protocol itself? Right. There's a lot of the times, like I think very famously, Uniswap still has basically no fee structure involved, and it's sort of the liquidity is like held up by the good graces of A16Z. There's not a lot of incentives to be an LP on something like Uniswap, and projects that have obviously launched tokens, like they create token incentives for that. But we have seen that some of the DeFi tokens that get launched have trouble maintaining their place in the market, in part because they don't really have sound economics underneath the hood. And some people have done a very good job building sustainable DeFi token models, but a lot of them haven't at this point. How do you sort of see that evolving for Zeta into the future?
It's a really good question. I mean, this is something that's in active development, and obviously tokenomics are a hard and I guess somewhat unsolved thing across the board, but we're definitely trying to put a lot of thought into it. So you raised a bunch of really good questions. I mean, in terms of the kind of business model, it's very standard exchange business model where it's based on trading fees. And in terms of how we incentivize liquidity, some of those participants, like it is an active liquidity protocol. So we need professional market makers, and it's a bit harder than the average person just putting stuff into a vault. So we do work with professional firms such as, Wintermute, for example. And, we do give them like rewards and stuff for market making. We actually have a pretty sophisticated market making program. It was actually modeled a little bit off DYDX, who are kind of the pioneers of this. So we have a whole complicated formula and the TIDU quote with the better uptime and kind of smaller spreads. We basically figure out over an epoch or a month by month basis, essentially how much we should reward in terms of tokens. So it's good that these kind of participants are like long-term aligned with the protocol. They're like, we want to build up a bag of the Zeta token, and that kind of increases our stake and our buy-in for the protocol. And we kind of put some capital at risk and we provide liquidity on the exchange within reason. So that's been good to kind of like bootstrap that initial liquidity.
Yeah.
And now it's a bit for, I guess the retail people, how do we buy them in and how do we kind of complete, I guess, the liquidity flywheel?
Yeah. So this is something I've always been kind of curious about. In traditional market structures, it's not like the New York Stock Exchange is going out and paying market makers to provide liquidity on the stock exchange. It's also not like Apple is going out and paying market makers to provide liquidity for Apple stock. So like, walk me through sort of how this stuff works in the long term, because protocol subsidies are something that is very common in crypto. It's very common in any sort of startup environment, that the assumption is you have to pay to get things kickstarted. But at some point, you hit a steady state where that isn't the case, or the foundation of Zeta has run out of tokens, and so it can't provide these things anymore. So what's the sort of graduation phase look like? Because most protocols today still need to have some direct relationship that is monetary with market makers. The market makers, for whatever reason, don't yet have the incentives to just purely do this on their own.
Yeah, that's correct. So I guess when you talk about traditional finance, the way that traditional market makers make their money is from the spreads of what they're quoting. So a maker will come in there, they place limit orders, and they'll say, hey, I want to quote Solana, between $99 and $101. Essentially, I'm willing to buy at $99 and willing to sell it 101. And so they kind of capture that, say, $2 spread in that case. If someone wants to come in there and do a taker order, they will go and they'll kind of make whatever that difference is there. Typically, it tends to be much smaller than that. $2 is huge. It's typically very small. But that is essentially what they do, and they do it over and over and over again. You can imagine if you're quoting, US Treasury bonds or something or other, it's just like like an absolute fraction of a cent, but they're doing it on the order of probably billions of dollars that actually ends up becoming like a significant amount. And so all your kind of Jumps and Jane Streets and Optivas, this is like their business model essentially. And that's why they're like massive, multi-billion-dollar companies that kind of print money every year. Unfortunately, with like crypto and especially DeFi stuff, I guess it is still in this kind of cold start problem, or liquidity is kind of king at the moment, and trying to bootstrap that is definitely difficult. I mean, things are less liquid and more risky, I guess, than traditional finance and centralized crypto finance. So usually things are always...
Is that really true though? Like, the only reason I'm challenging on this is like we are speaking on a day of high degrees of market tumult. And I think the thing I, at least anecdotally, have noticed in the last 10 years is markets in the traditional space have devolved into markets in the crypto space. When I think a lot of us felt that in 2017, crypto is going to graduate into being something more like the traditional equities market. But like we've seen just between, the COVID pandemic, market panics, into the oil going negative, into, we can look back over the last 4 years and pick out so many market events where it felt like equally crazy stuff was going on in the traditional markets as the crypto markets. And so I get this kind of answer sometimes from folks around like, market makers, they're just not there yet on crypto, or they haven't quite, there's something safer about the TradFi system. And I guess I'm just wondering, like, is that safety coming from like traditional insurance pools and like backstops and like gentlemen's agreements, or is it actually a market structure and dynamics issue? Like, is the volume in crypto just too low for market makers to be as profitable, and that's actually like the thing we're going after? Or like there's something there that I'm just missing. I think a lot of other people might be too.
Yeah, it's a good question. I mean, I can't comment absolutely here, given that I'm not a traditional equities market maker and not even a crypto market maker. But from my observations, obviously the guys in the traditional space have been around for decades. They have very kind of robust infrastructure there. They're also dealing with stuff that is highly, highly liquid. For example, like I mentioned, like treasury bonds are really going nowhere. This thing is like very, it's probably also insured in case anything kind of bad happens, but also there's just like an insane amount of liquidity. Like you could sell billions of dollars and not move the price at all. Whereas imagine if you tried to do that on your, typical altcoin token, it would just send the price to zero essentially. Even Bitcoin, I mean, look at the events of what's happening the last couple of days. There's some big ETH sellers, in the market, and that's just basically like tanking the hell out of the price. And so, the markets are struggling to kind of deal with this like massive sell pressure. And so my comment, I guess, was not on the security necessarily of the asset. I mean, yes, there is less liquidity, definitely. But then it's also like, I think market makers are a bit more sheepish when it comes to DeFi. At least that's been our interaction. They're like, hey, we got to worry about counterparty risk. At least Binance, even though I guess there are still some question marks with them, they've been around for enough years, and it's almost like a Darwinian thing. Yeah, they've just kind of survived long enough that we kind of trust them, I guess. I mean, people thought that about FTX as well. They're like, oh, these guys seem really legit. And then look what happened. But yeah, with DeFi, I mean, I agree with you. It's like these things are permissionless. These things, once you audit, I guess, the smart contract, you should be really safe with it. Yeah. But still, there have been countless hacks, and I think people have kind of PTSD from that. And then, like I mentioned before, just the performance aspect of it. If the chain goes down, touch wood, or like there's congestion or certain things happen. It's definitely happened to us. Unfortunately, in the early days, Solana did have its share of like downtime, which was quite difficult for us because we had like, call it millions of dollars of open, derivatives positions. The liveness would basically go down on the main chain, and then we were like, oh crap, what do we do for a couple of hours? Like people on the exchange are pinging us, and they're like, are you going to settle positions, or how's it going to happen when trading resumes? Or and the price usually moves a couple of %. And I saw it with some of these AMM dexes, like I think it was like Orca or something or other, I remember, would resume, and then suddenly just everyone would get liquidated, or the price would just have to recalibrate to where it had moved, like 10% or something or other, and just like this massive kind of chaos, I guess, when it reopened.
So I want to get into a little bit of what you brought up before around Zeta building an L2.
Mhm.
We've started to see, I think L2 is probably not the right term for what a lot of this stuff is, because L2 carries a whole bunch of baggage about how, L2s are fully centralized, L2s are fully ruggable, like all of these things that we have critiques of the L2 architectures as most of them currently exist today. But you're effectively talking about building some form of a subset scaling infrastructure that is related or based on the Solana mainnet that enables you to do different types of things. So walk me through, sort of in your own terminology without borrowing too much from the Ethereum terminology, like what are you guys building and why?
Yeah, I'll maybe start with the why. So we kind of have been building for the last couple of years. We've got an exchange that works pretty damn well. Like I said, it's done billions of dollars of volume traded on the exchange, and this is all kind of running through a Solana smart contract. And so we're pretty competitive, I would say, on the DeFi plane, but we're trying to go above and beyond, and we're trying to think, what is the future that I want in 10 years? I want people to control their own funds. I don't want things to be able to be rugged. I want a crypto exchange that actually runs on crypto. It isn't just basically an unregulated exchange that deals with digital currencies, which it basically currently is. And so we thought about all those kind of principles and what people care about. And we tried to engineer that into our plans for this. And so that's why it required a bit more, I guess, mucking around on the infrastructure layer, figuring out, hey, how can we tune some of the knobs to make it a bit more specific to, I guess, the perps use case and other kind of DeFi use cases that we really care about. So Solana, amazing general smart contract layer. It does NFTs, it does spot, it does lending, it does perps, it does gaming, it does kind of a bit of everything.
Yeah.
Then when we want to really specialize, we figured it was kind of a good time to be able to invest in that infrastructure and be able to tweak things like, block times, like latencies, like how people actually interact with the blockchain to make some of the kind of trading experience a bit easier. And so that's how we came up with this idea of, the kind of Zeta X and this kind of scaling layer. Yeah, so not to borrow the kind of L2 terminology, but I'll try and explain it in my own words. Essentially, what we're going to be doing is running a virtual machine. It won't be SVM, at least for now. It will just be kind of like a general purpose, like Rust virtual machine. To be more specific, it's a zero knowledge or ZK VM.
Yep.
And so basically what that means is we can just run arbitrary Rust matching engine / order book code, which we've basically already written. And that will be basically the foundation of our matching engine, our margin system, all the kind of stuff that we need for an exchange. And the beauty there is with some of the advancements that have happened in zero knowledge technology, working with folks like RiskZero is a really good example. They basically built this verifiable virtual machine, which we'll be using. So we can run arbitrary computation. So for example, someone places a limit order or trades or does whatever, we can verify that essentially and create, this succinct proof, the zero knowledge proof, and people can go and make sure that this sequencer or this kind of exchange, matching engine has actually acted truthfully. And so it's kind of nice in that we can centralize some of the computation and not have to run it over, a bajillion nodes and have to worry about the latency around the world. I know you guys are trying to solve it in a way. I know Tolly's trying to do these like multiple leaders and how to do funky stuff like that. But ultimately, there still has to be like network communication and consensus around the world. And that just makes it very hard, I guess, for a high frequency exchange to be able to compete with the centralized guys. So in this kind of case, yeah, we can kind of bring things more down to kind of like a central sequencer, but we can still have the properties that we want in that, it's verifiable and people can kind of trust that the computation has been done there properly. The nice thing as well is if this sequencer or this kind of central virtual machine essentially that's running all these order book computations, if that starts acting up, it starts censoring people. It actually can't like do malicious stuff like steal money from people. So purely the sequencer and kind of this roll up sense, all it does is just order transactions. So that's kind of what Solana does on the L1, but we kind of need it on the L2. And the good thing is it can't commit fraud essentially. It just can kind of misorder things and do a bit of MEV. But if people kind of spot that this thing has been playing up, you can actually kind of just circumvent, and there's an escape hatch, and you can go back to the L1. You can be like, hey, I want to withdraw my money from this L2. You can always drop back to the L1. So why don't you do that all the time? Obviously it just brings you back to the L1. Things are a little bit slower. It kind of loses all the benefits of the L2, but there is that escape hatch. And so what's the beautiful thing about the L2? We get stuff like pre-confirmation. So you can actually talk directly to the sequencer, and even though it's like not 100% guaranteed, it's probably like, 99.99% that this thing's not going to roll back. You can talk directly to this thing, to the order book. You can place the order, and within, let's call it 5 milliseconds, you'll know if that's kind of gone through and that's been matched. And so that starts just accelerating us 100 times in terms of the performance and throughput that we can get. And so that's really nice that our computation is now offloaded from Solana. So we don't have to use the SVM for all the kind of computation. It's pretty damn fast, but for our specific exchange use case, we need to bring it, 10 to 100 times faster to be really competitive with those guys. But then the beautiful thing is we're not just running, a centralized exchange at that point. The thing is verifiable and it's secured by Solana essentially, because all that data is getting posted back to Solana. Anyone can read that data. They can be like, this is the state that I saw at my time. They can kind of dispute other people in the rollup. And Solana, essentially, the Solana, consensus nodes are all going and voting on those kind of DA blocks that are going through Solana. So you get the security of Solana, you take the computation and you make it a ton faster, and you can kind of verify it. And for us, this is like the model that we've come up with that we think will get us the best performance, lowest latencies, best user experience, and still have the security and hopefully the kind of easily bridge liquidity of Solana.
Cool. So I want to go through sort of some of the typical L2 roll-up-y questions as we go through this. So where does the compute come from?
So basically, there would just be kind of a sequencer that runs this order book code. Like I mentioned, it can just be any kind of arbitrary Rust code, and we've basically coded up a full matching engine. This thing will just run on like a bare metal box or whatever it might be, and people can kind of talk to that just over standard APIs. We don't have to deal with kind of JSON RPC and all these kind of complicated stuff. That actually really helps us with market makers, for example. They're used to like REST protocols with all these other centralized exchanges. So we can basically build something that looks and feels like a centralized exchange. People can kind of post to that. This thing will sequence them and kind of place those orders off chain. And then people can kind of go verify it. They would run similarly their own RISC-0 VM and be able to kind of do fraud proofs and challenge certain stuff. But yeah, everything is essentially running on whatever kind of node hardware that you would kind of potentially want. But yeah, it should be able to be pretty scalable. But essentially, that doesn't have to be run by Solana validators. We can kind of run it separate from that.
And then walk me through, you mentioned 5 millisecond pre-confirmations. Like, what does the timing look like for pre-confirmation, full confirmation? To use, again, the classic term settlement back to the Solana L1. If you're trying to exit, what do those exit times look like? Yeah, like what's that timing for various levels of security achievement?
So the pre-confirmation, essentially, you will be firing off that API request and you'll be like, hey, I wanna buy Solana at this price. That will go, it'll hit the sequencer. So that's basically just going to be latency over the network. So we're expecting, if you're kind of co-located, say if you are a professional trading firm and you're co-located in same AWS zone or whatever, 5 milliseconds, I think very reasonable. So you can get this thing very, very fast. That's basically what you see with Binance. I think it's like 20 milliseconds or something like that. So it's a very, very, very fast. And this kind of state machine, I guess, of the order book that's running in this sequencer is running, a bit ahead of what all the kind of, I guess, like the full nodes or the validators of the L2 would be kind of running. They've basically, what will happen, I guess, the transaction lifecycle, it'll go into that sequencer. The sequencer will essentially like sequence everything, and then things will get kind of posted back down to the L1 onto the data availability layer. And then people can kind of go read the data availability layer when it becomes available, and then be able to run those transactions through themselves, verify everything. So as you can imagine, Solana block times 400 milliseconds. Sometimes if we're posting a batch of quite a lot of transactions, we will most likely have to chunk that up over multiple instructions, multiple transactions. So I'm estimating things will probably take a couple of seconds to get posted down to the kind of Solana layer and then kind of read back up. So that's kind of, I think, how long it will take. I don't imagine it would take more than 5 or 10 seconds to get data available on that kind of layer, which is pretty fast, I would say. And then in terms of the actual withdrawal time, so yeah, that's one thing, is you've got to synchronize the base layer and what's happening there with the kind of L2 and make sure that there's not race conditions. So I chatted to Tolly a bunch about that. He's pretty confident that you could get it to like 30 or 40 milliseconds in the kind of design that he had, which kind of doesn't deal with some of the rollup complexity that we wanted to get to. That's maybe like the end state of what we can get to. I think we're a bit further off that because we're doing essentially an optimistic rollup. Unfortunately, there is some element of, because it's optimistic, you kind of let the chain run. You have to rely on, I guess, good behavior and fraud proofs, so people to actually kind of challenge that. So our kind of withdrawal time is probably, I think Optimism is 7 days. I think ours, because Solana block times are kind of a lot faster, obviously we can probably bring that down a bunch to within a day, probably a bit less than a day. And then the nice thing is one of the teams we're working with is developing more on the kind of ZK proving side. So we can potentially do a bit of a hybrid where instead of dealing with purely optimistic for kind of withdrawals, we can actually submit a proof for that and do some of this kind of ZK magic. And that should bring it down to, I guess, probably like an hour or, however long it takes to do these proofs, usually kind of like 15 minutes at least. So I think we can get pretty good end goal there. So for the end user, what does that actually mean? If you're posting stuff onto Zeta and you want to place a trade, you should basically click the thing and you will get an acknowledgement within 5 milliseconds. And there's a very, very like basically zero chance of that rolling back unless something catastrophic happens. And then in the background, obviously this will become available to kind of nodes. People can kind of verify and prove stuff and that data will be available. And then if you want to withdraw off the chain, we imagine it will probably in the early days take a couple of hours, and we can probably bring that down to like 15 to 30 minutes, which we think is like, it's not crazy. It's reasonable. The thing that we're trying to solve more for is like, how do we get deposits really fast? Because I think that's the painful thing. Whenever I've used Arbitrum and other ones like this, I put my money in there and I'm just kind of like sitting there waiting for this like Ethereum to kind of do all its confirmations. And it usually takes like 15 minutes at least. So I think our deposit should be very fast. We're probably going to run in kind of like a trust minimized setup to start, and we can get it pretty quick. And then hopefully, we can kind of make it more trustless over time.
So walk me through a little bit of the security model around proving. So this is one of those pieces where you hear a lot from the zero knowledge community saying things like, oh, well, once the data is posted, anyone can challenge the data. They can run the proof themselves. And if there's something that's found to be wrong, there's a big bounty and big payout to happen. The critique of that is that assumes that those bounties and payouts actually exist. And right now, the actual act of proving this stuff is not cheap, right? There are real computational and infrastructure costs to proving it out. And so far, I don't believe there's ever been a bounty claimed on a zero knowledge challenge that wasn't intentionally planted there as to test the network. And so I think you could look at one of these systems and say, look, there's basically no incentive to provide security for it because it's sort of like it's like trying to crowdfund like a nuclear missile warning system. Like it's so unlikely there's ever going to be a nuclear missile headed for your city that like if you just leave it up to people to like crowdfund that system, no one's going to build it because it's or an asteroid defense system for the planet. These are once in a blue moon type situations, but if you don't have them, the entire security assumption breaks down. So how are you guys thinking about that type of a problem?
Yeah, really, really good question. To be honest, this is like probably one of the things that's a bit later or like towards the end of our roadmap. Sure. Thinking about the kind of economics on that. So I don't have a definitive answer at the moment. I mean, definitely acknowledge your observation that proving costs are pretty significant. It's why you see stuff like Starkware, I think, actually has like massive proving costs, and they have to kind of batch and amortize stuff over. That's why the things tend to be a bit slower on those kind of ZK side for stuff like Starkware. Things take kind of hours because they have to batch all these proofs together and solve them. And they kind of, a lot of it just has to be subsidized, I guess, through the kind of native token. That's just like how things kind of go at the moment. We're probably going to do something similar, to be honest. I don't have kind of like a silver bullet on how to kind of solve this specific kind of security thing, but it's definitely a cost.
Yeah, it's always struck me that like we've kind of reinvented Bitcoin, but without the block rewards. with all this stuff where we're like, oh, just run all this massive computational load to secure a network, and someday you could potentially maybe get paid. And it feels like an interesting application for something like embedding some sort of reward token mining into the proof generation at some point. Like, could be an interesting way to sort of solve this, because like there's a strange thing in sort of like this sort of like next gen DeFi, and this not, you guys are very much not alone in this category, but like we've built really cool, impressive systems that in some way rely on goodwill and treating people as good actors in order to maintain a lot of their security functions, which feels like it is the way that systems in high trust social settings work, but is sort of different than the sort of first generation of DeFi was built out to be.
Yeah, that's correct.
Yeah.
The only caveat I will make is like we will probably be starting in more kind of a optimistic setup, and that's pretty cheap to run, obviously, because you don't have to do a bunch of the ZK proving. But like everyone says in the rollup space, ZK seems to be the end goal, the holy grail of a lot of this stuff. And I think something that will be good is, like Solana also scales with hardware. I think a lot of the ZK circuits continually just getting better. There's like massive breakthroughs, I guess, both on the kind of circuit software side as well as hardware side that people are making in leaps and bounds. And the technology is very new. It's only really been around for a couple of years. So I imagine over the life cycle of how this thing goes, not only is Solana going to get way cheaper with stuff like Fidancer, but I think you're also going to see ZK stuff in general just advance a lot. And I think there's already been just like massive improvements and ZK support on the Solana side as well, which is why I'm very excited, because it's like we get to benefit from base chain scalability, and then the absolute legends at Light Protocol and Helios are doing all this groundbreaking work as well, just bringing a bunch of that onto Solana from the ZK side. So it's nice to be able to tap into both of those.
I've wanted to do an episode for a while on why ZK hardware acceleration is still so far away. And my understanding is that basically everyone's using custom algorithms and there's no standardization in how you're actually going about the proof. And because of that, there's like the ZK prize should have succeeded, and instead it kind of failed as a project. A topic for another episode, but it's something I've been thinking a lot about, is like, where is all this ZK hardware acceleration we were promised in 2018? But it is really cool that it's still, even with all of the proving costs and limitations associated with it, it's still practical enough for something like you guys to build a whole system around this technology and say, we can actually still produce faster block times than you would expect on a mainnet. So it's pretty neat to see. So what's the status of this L2 system now? Where are you guys in the development process?
Yes, good question. So we're pretty advanced, or I say making like pretty good progress on this. I'm actually hoping to get a demo out by Breakpoint, ideally a live demo, but if things don't quite hit those deadlines, we'll at least have like a screen recording or something or other. So very excited for that. So if people are going to Breakpoint, please do come to my talk. We're making good progress on that. We hired a few more backend engineers who are making progress on the business logic. So there is a lot of exchange redesign stuff that we wanted to do. We've had probably like 2 years of smart contract tech debt that we're now just like wiping this like clean. It's like now we want to support stuff like multi collateral, which we haven't had for a long time. We've always been USDC margin. So we were like, hey, let's redesign our margin system entirely. People want to use Sol, they want to use Jito Sol, they want to use all these different things to kind of margin. So that requires a bit more advanced functionality, things to be kind of rethought. But doing a kind of ground up rebuild of the exchange with the 3 to 4 years of knowledge of exchange building that we have now, I think has been pretty helpful. Pulling ourselves away from the old terrible Serum code base is an absolute blessing. So we're very happy to just be able to write things in Rust and not have to deal with the kind of constraints that we had there. So that's tracking pretty well. And then on the actual roll-up side, which is maybe a bit more interesting, so we have some of the basics there, where we're kind of working with an infrastructure partner on this, like really smart bunch of guys called like the Sovereign Labs team. They're kind of building a bunch of software tools for that. We really like them. They're just like genius guys, just know infinitely more about roll-ups than most people we've met, and just like really serious about it. And so they've helped us with a bunch of custom stuff, and we're working very closely. So we already have something that's essentially just running very simple kind of order book operations. We're able to take all those different transactions, batch them up, aggregate them, and post them down onto a DA layer. So we've kind of got it working with like a mock DA layer, which is just like a database right at the moment. We're in the interim just trying to get it to work with Celestia, because that's just, it just exists already. We can kind of put DA on there. So we already got a few DA blocks there. It's, somewhere on the Celestia testnet, and that's been working, which is kind of good. And then we're also in the progress of building out a Solana DA adapter. So there's just some kind of like thought around how we kind of chunk things up, how we work around Solana's kind of transaction submission model, and how we kind of pull stuff out through Geyser and stuff like that, just to make it very fast. So no one's built this DA adapter, and that's kind of new grounds, and kind of we'll be pushing probably a lot of data through Solana and saturating the block space a little bit. So we're trying to think about how to do it in an efficient way, how to do it so it's kind of like parallel, and we're not just kind of like blocking ourselves. I don't know. There's just like a lot of engineering things, and it's very new grounds.
Yeah, talk to me a little bit about Solana as DA.
Yeah. So I think a lot of people have talked about it, which is pretty cool. People are like, why doesn't it make sense? Solana has fairly abundant bandwidth, and quite a lot like cheap storage, and you're getting all this kind of state compression stuff coming out. So it kind of makes a lot more sense that Solana can be actually kind of a juggernaut for DA stuff. And you have already specialized blockchains like Celestia who are trying to tackle this problem. What if you could do it with an existing Solana blockchain? And so that's kind of what we wanted to tackle. We were like, I don't want to become just like another sovereign rollup on Celestia. Let's actually do it with Solana. And what's the advantage of doing it on Solana? We get native deposits essentially from the L1, so it's going to make it like very fast, and you don't have to like muck around going into this kind of a random app chain. And then furthermore, the nice thing is down the road in the future, for what we understand, if you have a bunch of different rollups who kind of share the same DA layer, you actually get this kind of really nice composability benefits between them. So we figured more people can actually start using that. Once we've built it, we can kind of get this ecosystem of rollups and kind of start building out more people building on this kind of L2. So we think there's some good advantages there. In terms of the actual technical stuff, I mean, it's pretty simple. All you need to do is take the transaction data that you would have normally done, instead of basically putting that through the Solana virtual machine, which will run it and format it, I guess, and save it in its own way that it can natively understand. Like basically the stuff you read in a block explorer is all formatted and parsed. You have all the information there. You can kind of understand. With this blob data that you're getting from the L2, that's kind of the distinction, is the L1 actually has no idea what the hell that is. It doesn't validate it. It doesn't run it through. It's like, for example, like these signers are valid, or this drained, or this it took out more balance than existed in this kind of account. That's the runtime checks that Solana does. But this, you're just taking a binary blob, you're just chucking it on there, and it's just going to be in the call data essentially of your transaction, and it's up to the rollup and the full nodes of the rollup to go and verify that. They basically go, and it's like if you were to ever kind of pull data off the Solana blockchain, you do like the get transaction method or whatever. You grab it from the RPC, and you would just kind of take that those kind of bytes and be able to pull out, I guess, the rollup data and be able to verify that. But the L1 itself, and if you were to look at it on block explorers, would be kind of completely blind, I guess, to the fact of what's on there.
I mean, blobs and inscriptions share a lot more similarities than differences. It's very interesting. Yeah. Well, Tristan, if folks are interested in learning more about Zeta and following the progress on this L2 system you're building, where can they find out more?
Yeah, I think the best place is Twitter. So at Zeta Markets is our kind of protocol page. I'm also on Twitter at Tristan0x. Post a lot about Solana over the years, and always good to just kind of like at me on certain stuff if you're interested, or kind of DM me. Always happy to have a conversation. And otherwise, like Telegram's a good place to get us. We have a public Telegram chat that anyone can kind of get in and check up on progress and ask questions. So would love people to give feedback and ask questions and be involved in the conversation, because I think the next couple of months are at least going to be very exciting. And if anyone's at Breakpoint, obviously come by, say hi, and looking forward to discussing things.
All right. Well, thanks for joining us today.
Thanks for having me, Austin. Appreciate it.